Hey there guys, Chillingworth here. Welcome to probably the first video I've done on YouTube for quite some time, and really excited to do this video because I want to show you guys something different. Okay, something a bit new, something a bit different for the channel, and I think a lot of you guys that are trading, investing, spread betting out there will find this stuff useful. I hope you do. If you do, please let me know, and I'll do some more of these videos. So today I want to do something different. I want to show you guys some of the work that I've been doing now over 2019, where I'm analysing companies for what I'm calling the clean watch list. This is a watch list of at the moment FTSE based stocks that I'm then subtracting from all the other stocks that are out there, and highlighting, focusing down on just these companies and using mechanical, systematic, trend following strategies just to trade those companies. So it's taking stock selection and becoming more sophisticated about how we selecting the companies that we're trend following, that we're applying our mechanical systems to. And I want to show you guys a kind of sample of that, I suppose, of the work that's been doing. I want to look at one FTSE 100 company that I'm not going to be buying or looking for long signals in. They didn't make it into the clean watch list, and I'm going to show you one company that did. And I want to show you the difference and the kind of stuff that we're looking for, what we're looking at between the two different companies. And I think it's going to be quite interesting. I think it's going to be quite useful. To the point, what are we going to talk about today? So I want to talk to you about these stocks. Let's dive in and start taking a look at these companies that I'm harping on about. Now, these are companies that I've been looking at for a while, and I've been recommending to my members. So I have a membership group called the Inner Circle. At the moment, we've got 35 people in there, so it's a very select, exclusive membership. And those guys are the only people that get to see what's on my watch list. They're the only people that get to know all of the analysis that I run. Every single day I post a piece of analysis on a company, sometimes more than one company. This morning I did 4 different companies, and we're looking at all the winners and losers. So we're looking at all the companies that do make it to the watch list and all the companies that don't make it to the watch list, because I think it's important to know which companies haven't made it through, which companies haven't made it through the test, but more importantly, why didn't they make it into the watch list, for what reason. Now, often that's because they are relatively good companies in themselves. They're just not the cream of the crop. They're just not good enough. They're good, but they're not good enough to make it into the watch list. And I'm looking for the best of the best, the companies that are going to... what we're trying to do is build this watch list of companies that are the best. And so what we should see reflected on the charts is a share price that's growing, that's going higher and higher and higher, because investors are piling in, because they're seeing these great results coming out of this company. But what I'm also looking for here is also signs or signs underneath of not manipulation, but what companies will do is they'll post that they made record profits this year, but when you actually start going through the financial information and the annual reports and the financial statements, you'll see that actually that profit wasn't necessarily made from the recurring business of that company, what they do on a day-to-day basis, but instead it was from the sale of a sale of an asset that year, that isn't part of their day-to-day business. It's just they sold off a big piece of property, or they sold off a big asset of some sort that brought in a load of profit, and obviously made the numbers look a bit better than they are. Now, they're not misleading the general public or investors in any way, because they have to do that by law. They have to, in their accounts, they have to state, that they made that profit from, and it's all broken down in the financial statements. And it takes a keen eye and someone who knows what they're looking for to identify where is that profit actually coming from. Is it coming from recurring business? And so sometimes you can find these companies that they look great on paper if you're just looking at net profit, but actually when you dig down and find out, well, where's that profit come from, then you start to see, actually, if we extract these kind of extraneous, these extraordinary incomes that come through, and just look at the core business of what it's actually churning out, you can actually see that actually they didn't make as much money as they said they did, and actually they've made a worse result than the previous year or whatever. And so we start to see what's going on behind the scenes and underlying progress. And most investors, the proper investors, the big investors that are really kind of transferring huge volumes of shares, they know this stuff. They're looking at this stuff. And so what you generally see is the share price moves in accordance. So you get these big companies that look really good, but their share prices are all over the place. And that's largely because of what's going on with the numbers. And what I found is a direct correlation between companies that I'm putting in the clean watch list because of the numbers, purely because of the numbers, because of the fundamentals. They're looking great. They're doing everything. They're ticking all the boxes of what I'm looking for personally in a company. I have my own criteria that's private to me, that I'm looking at this criteria and I'm saying, right, does this company pass the test? It takes me about 2 or 3 hours sometimes to look at a particular company, and then I decide. I look at the facts. There's no opinion, there's no bias. It's just, do they make the grade based on the numbers? If they do, they go into the clean watch list. I then use what's in the watch list to identify these stocks that I'm looking for signals on. I'm applying my mechanical systematic trading system to those companies. And what we found is a direct correlation between companies that are making it into the watch list and fantastic opportunities on these moving average or on these mechanical systematic trading systems. And so that's been really great news. It means that the work I'm putting in here, analysing these companies, is really paying off. And the 35 people that are in the inner circle are the only people that get to know who's in the watch list. Okay, and that's just part of a reward for the fact that these guys are in my inner circle and they get to see this information. However, from time to time, not very often, but from time to time, I'm going to be sharing bits and pieces of companies that are in that watch list, and also more inclined to share the companies that didn't make it. You know, there's got to be there's an exclusivity there in being part of the inner circle and getting access to that stuff that I don't want to break. I don't want to, just start kind of steamrolling that, sharing everything on my YouTube. I want to honour the exclusivity of being part of the inner circle and getting access to that information, but from time to time I will be sharing bits and pieces of certain companies that have made it into the watch list, companies that I particularly like, and that's shared on my website, thecleantrader.com, which is a new website that I've had running for a while now. But haven't really promoted, haven't really sent anybody there because the content's been relatively limited. But today, now, we are kind of pushing that a bit more and showing people that there is a website there, that we are sharing some really good articles and some really good information on that website. And it's free to go and have a look at if that's something that you're interested in and want to see some of the other companies that I've turned away and some of the other companies that I have taken on board and put into the watch list. The watch list is ever growing and it's ever evolving, so every day it can change. Companies can fall out of the watch list because they post poor results, or they no longer make the grade. Equally, other companies are constantly popping into that watch list. Other companies have been there since the data that they were posting in 2008. They would have been in that watch list. So it's a mixture. It's dynamic. It's always moving. But anyway, let's take a look at some of these companies. So the first company I want to look at is a company that didn't make the grade. And this is a bit of a surprise for some people because a lot of people assume this company are huge and fantastic and one of the staples of the UK stock market. It's GlaxoSmithKline, pharmaceutical company. And we're going to take a look at their results of the analysis that I run on this company. So let me just find their details. So I have to excuse the crude Excel spreadsheet style of what I'm doing here. It's pretty, it serves its purpose for me and shows me exactly what works and what doesn't, so to speak. And I want to show you a comparison between the two. So this is GSK, GlaxoSmithKline PLC. This is 10 years worth of financial data stripped, taken apart and put into a criteria that I'm looking at personally. So what we can see here is we can see the turnover, the revenue, the cost of sales, the gross margin, first of all, is the first thing I'm looking at. So what's the gross margin for this company? At the moment, it's about 66%. So that's basically what's left. Once they've obviously got all the revenue coming in, what's the cost of getting that revenue in? So we're not looking at company expenses like staff or wages and rent or anything yet. We're just looking at what's the raw cost. So if this was, a shoe company, what's the cost of actually getting those shoes in the first place, or getting those shoes made so that they can be sold. And then what's left for the company off the back of that? What's the gross profit? So that's pretty healthy. It's not fantastic, but it's pretty healthy. It's pretty good. And then we look at the expenses. So what are the expenses of the company? The rent, the staff costs, stuff like that. And again, that's at a decent level for them. One of the bad things for GlaxoSmithKline was the R&D ratio, the research and development, and that's too high. For what I'm looking for, now I'm not saying it's, and this is where you need to make the important distinction here in what I'm doing. GlaxoSmithKline are a fantastic company. You can make a lot of money through trading and possibly investing in GlaxoSmithKline. But for me, for my personal criteria, the R&D levels are too high. The research and development of this company, the money that's been spent on research and development is obviously a necessity for them to remain competitive in their industry, and you're going to find high R&D costs in pharmaceuticals and biotech, of course. But it's too high for me, and it's just something that I don't like. A lot of the money that would have gone to shareholders going into R&D. We've got interest expense on debt has been too high in several years. Over the last 5 years, 3 of those years, it's been far too high, where they're paying 25% of their profits just being spent on the interest being paid back on debt. So that's a lot. That's too much for me. And then we come down to actual net earnings, and unfortunately the last 3 years, whilst they've been making inroads, they've been moving upwards. 3.8% net earnings, 6.8% net earnings. Those weren't very good years, 2016, 2017 for GlaxoSmithKline. And those net earnings results are under what I'm looking for. They're just too paper thin. When you look at, they've taken 1 billion, I think that's 1 billion out of 27 billion. It's still 1 billion profit, of course, but it's a small percentage of what they're actually bringing into the business. That means it's costing them a lot to run that business, and that's not something that I'm particularly interested in terms of my criteria. And when I say, I'm not interested in, what I'm saying here is that there are other companies out there that I would be more inclined to put my money into rather than GlaxoSmithKline off the back of the results that I found. 2018 was a better year, but still, it's and interest on debt has gone down. R&D's kind of remained the same, and obviously net earnings has gone up. So that's encouraging, but it's still not quite where I want it to be. Then we come down to the balance sheet. So that was the income statement. Then we analyse the balance sheet and we look at assets versus liabilities. And the assets versus liabilities isn't too bad. Debt has gone up quite a bit recently. It's jumped from 14 billion to 20 billion of debt outstanding with this company. So something else I like to look at is the net earnings to long-term debt ratio. This is a real simple ratio that basically just works out, okay, based on the net earnings of the company, how long would it take them to pay off that long-term debt? Now, this helps you track whether debt's getting out of hand. Is the debt getting too big for the company based on what they bring in financially? And GlaxoSmithKline been fine for a while. They had a couple of wild years where net earning, it wasn't so much that the debt went up, it was that the net earnings went down, and so then they got to the point where it was like, okay, warning sign, if the net earnings stay at this level, they're not going to be able to pay off their debt for a long, long time. But it recovered, and that was the net earnings that recovered. But in the last couple of years, net earnings has not been good. As we saw up here, it went down to 3.8%, 6.8%. That was a worry because obviously the debt didn't go down, the debt remained the same. And so at one point it was going to take them 14 years to pay back their long-term debt, which is a concern. At that point it starts to get too big, and you need to, that hits the criteria of these guys don't make it into the watch list. Now this has been improving, but we're still looking at 6 years at the moment based on current net earnings to pay off their long-term debt. That's still too high, and therefore that's another red flag against them in terms of making it into the clean watch list. Something else I want to look at as well is the retained earnings of this company. Now retained earnings is, and I talk a lot about this with the Inner Circle students, but retained earnings is a pot of money that these companies keep aside It's profit that's left over for the shareholders, essentially. And then what they would do is they will pay some of that out in dividends. They might buy back some of their own shares, or they'll put it in a pot to use. It might be so that they don't need to take on debt in the future. It might be so that they can invest that in acquisitions and buying other companies and not having to borrow money to do that. It's just money that they're putting away. And we like to see retained earnings growing. Okay, now retained earnings were fine for a few years, from 2008 to sort of 2012, 2013, 2014 onwards. The retained earnings went into a negative amount of about, I think we're looking at 2 billion there, and it fell to minus 5 billion, minus 6 billion, and it's gone back up a little bit in the last year to minus 2 billion, but that's not good. We don't like minus amounts in the retained earnings because that's where money should be building, not dropping. And it may be that there was an acquisition of some sort and they had to dip into that, but it means they're spending above their means on top of the debt that they've already got outstanding. So that's a concern. We also like to see them buying back their own shares, because what that means is that there's less shares out there in the market. That increases the share price because there's more demand for the remaining shares that are left out there. But they've not been doing that since 2014. They stopped buying back their own shares. Now that might be because of restrictions, because they're only allowed to buy back a certain amount of them. But again, it's unfortunate because they win points in my criteria for buying back their own shares. And otherwise, these guys are okay. GlaxoSmithKline are okay, but they won't make it onto the watch list because there's a few red flags here. Now they could turn that around and they could improve, but right now we've got R&D rates that are too high. We've got interest on debt too high at the moment. We've got net earnings at 11%. It's just high enough, but we want to see consistency here now. We need to see consistency in this company for them to make it into the watch list, and right now we haven't seen that. We've obviously got long term on high debt, and at the moment, we're hoping that's going to start going down, but the debt has gone up. It's gone from 14 billion to 20 billion in debt, which is not good, and so that's not due to a drop in net earnings. That's due to a much higher increase in taking on extra debt, which concerns me, and it's not something that I'm particularly fond of. And so there's a few red flags in here, and so these guys didn't make it into the clean watch list. Like I say, with GSK, you could go and make some good money with GSK. I'm not saying that you can't. I'm saying that this is my approach. This is my analysis and the way I'm doing things, and it works really nicely. And this is the chart of GlaxoSmithKline over those 8 years. So we're looking at 8 years worth of trading, and as you can see, it's pretty erratic. It's all over the place. There's no real strong trend there. There has been some upside, but it's a bit messy. And this is just using the 5 and the 400 EMA, so it's a very long-term trading system over 10 years. But as you can see, it's not pretty, and the opportunities have been here, but there have been a lot of losing trades in that approach as well. And a company that doesn't make the watch list generally has charts like this, where we wouldn't have done well just trading the system in this way. Now, following up here, I want to show you a company called Halma. This is a company, another FTSE 100 company that are on my watch list, and I want to walk you through this process, and I want to show you the difference between the two companies. So again, no company makes it onto the watch list just based on their chart, just based on their share price. That's not enough. It's based on the financials. And so we look at the company's financials before we even consider do they make it onto the watch list. The financials dictate whether they make it onto there or not. And we're looking at Halma here from the last 10 years worth of data. We've actually got a little bit extra, I think 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 years worth of data. So yeah, we've got extra information here, which is always good. The more the better. Now, first of all, we've got gross margin up here is actually 16%. Now, that's not a true reflection of the company, because the way they publish their accounts, their expenses are wrapped into that. So a large percentage of the cost of sales would actually come out in expenses, and so we'd actually see a much better gross margin there. What we're really interested in is obviously the interest on debt, which is nice and low at 3 to 5% right now. So about 5% of the leftover profit, the operating profit, is being spent on interest on debt. That's at a manageable level. We're happy with that, no problems at all. So of the 181, I think that's million, that's the profit left over, they spend 9 million on the interest on debt. You know, ideally there'd be no debt, but sometimes companies can make debt work for them. If you can borrow at 5% and spend, if you can borrow at 5% and make 12% on that, then you know it's good debt. So debt's just not necessarily bad, but we want to make sure that they're managing the level of debt that they're taking on. So that's all good. 5% is very, very healthy compared to GlaxoSmithKline, which was a lot higher. And then if we come down to net earnings, these guys are at 15 to 16%. That's more like it. And what's more important for me is the consistency. Every year, these guys have not had any blips. They've been consistently growing every single year. That net earnings has been growing and growing and growing. There was a bit of a drop between 2014 and 2015, but still solid growth. That's exactly what I'm looking for. And so I like that. I like that consistency. That means over the last 12 years, these guys have just been consistently getting better and stronger and growing every single year. And at a rate that's been good, you know, between 13 and 16% net earnings every year. Lovely. We can look at the assets against liabilities. Well, their assets against liabilities is nice and strong. They've got more assets than they have liabilities. That's exactly what we want. We can look at the net earnings against the debt. So like we looked at GlaxoSmithKline, where at some cases we were looking at nearly 20 years to pay back their debt. These guys don't have anywhere near as much debt as GlaxoSmithKline. We're talking at 20 billion before. We're looking at 289 million with Halma. And it's going to take them, based on their net earnings, based on what they're bringing into the company and in terms of profit, it's only going to take them 1.7 years to pay off that debt. So that's perfectly being managed at a very nice level. Perfectly adequate for the size of the company and what they're actually making. So we can take a look at the retained earnings for this company, and as you can see, the retained earnings have been fantastic. Every single year we've seen growth in retained earnings, you know, growth of 12.4%, 10%, 14, 17, 18, 13, 19%. Every year they've been pumping more and more, over 10% a year growth in the retained earnings pot. Great sign. What's more important to me? Consistency. 12 years of consistent application to putting more money into that pot. That's great. That's a great sign, because it means they've been able to do as well as they've done and still be pumping money aside. This is profit that's left over for shareholders. So they've been paying their dividends, they've been doing everything else that they do with that profit, but a big chunk of it's been being put into a pot, and that's great news. That means they're sitting on, you know, I think that's 691 million just sitting there waiting to be used for something. Treasury shares, so they've been buying back their own shares consistently every single year over the last 12 years. They've been repeatedly every year spending some of that money that's left over in buying back some of their own shares. That's slowly reduced the amount of shares that are out there on the market. Great news. And then we're looking at return on shareholders' equity, which is great at 20%, 21%. And that is a breakdown and a visual on, okay, how well is this company buying assets and putting those assets to work? Assets should be generating some form of income for the business. And so we can work out, right, so of the net assets, how much is that company actually putting those assets to work? Because what you can find with other companies is that they're buying assets, but there's no actual extra income coming in. They're purchasing all this property, plant and equipment and all these different assets that they have and intangible assets, but they're not actually bringing in any extra income. And so they're not necessarily good assets to buy. They're not necessarily putting their money in and investing that money in good assets. Whereas Halma are doing very well because they're making a good return on the assets that they've been buying. And then we can look at capital expenditures, well within what we're looking for, the money that they're spending on purchase of property, plant and equipment and intangible assets, well within their means, and they're looking solid. And you can see there's so much more green here. You can even ignore this red purely because of the breakdown of the expenses against the cost of sales hasn't been done, and so therefore it looks worse than it is. You can see a sea of green, pretty much. You know, there are some red dots in here, but a sea of green essentially. And this is a company that ticks all the boxes for what I'm looking for and more in a company. And so then we go, okay, great. So we would have known probably by 2010, 2011 that this company made the grade. Once we've seen a couple of years of consistent, profits, consistent reports in this way. In fact, we're looking at probably 2009, and maybe prior to that, because I've only gone back to 2007. So maybe even before 2007, if the years prior to that were just as good, then after about 3 years of consistency here, we would have said, okay, great, these guys are eligible for the clean watch list. We've been ready to look for long signals with this company in the clean watch list. So then we can go into having a look at the chart, and we can say, okay, great, well, these guys are on the clean watch list right now, and it would have been back from, say, 2009. So this is an example of what a lot of the clean watch list companies look like. And when you look at 2009, these guys, let's say December 2009, we would have known these guys were eligible for the clean watch list. They were trading at £2.50. Okay, today, Halma trading at £19.93, nearly 20 quid. So a massive increase. And again, we're using the same moving averages on this chart as compared to GlaxoSmithKline, but where a lot of investors will trade GlaxoSmithKline because they're just a name, they're a brand, they're a big company that people know about, they're a UK staple, of the UK stock market. Everyone's heard of them. They produce a lot of household brand names and stuff like that everyone knows. And a lot of people will invest in that company just because they think it's the right company to invest in. When actually you crunch the numbers, Halma have been a far better place to put your money over the last 10, 12 years. And you can see here, just using a mechanical systematic trading system like a 5400 long term, don't get me wrong, very long term system. It's almost buy and hold, right? Very rarely do we get out of this market unless you're trading something like GlaxoSmithKline, in which case you would have been in and out all the time because you saw that chart, it was a mess. With Halma, we would have got in 2009. We may have bought even some more if you were buying shares, or spread betting. You might have got out here and got back in, 6 months later at about £3.50 back in January 2012. We would have got out of that at about £9 in December 2016, but soon got back in again. So we've only had a handful of signals. This has been a fantastic ride. And we would have, and that's the point, going back through the financials, we would have known, that's the wrong one. Going back through the financials, we would have known back in March 2009, when that report came out, that would have probably been the latest that we would have said, okay, these guys qualify, they've ticked all the boxes for the clean watch list criteria of what I'm looking for in a company, we need to add them to the watch list. And then we add them to the watch list and we're just looking for signals, we're just getting into this market. Now, you might not necessarily be trading, the 5400, but you can trade this on many different mechanical moving average systems or breakout systems or whatever it is you use, mechanical trading systems, trend following systems. You could absolutely have made a bomb. And that's just one of the many different companies that are in the clean watch list right now that will show very, very similar results. Now, I'm sharing this information only with the 35 people that are currently in my inner circle. It's a very exclusive, small group of people. It's a small group because I do a lot of one-to-one coaching with them, amongst other things. And so I can't spread myself too thin. I can't take too many people on in this group. And I may well be adding some more people to it in the short term, but yeah, it's something that we're working on. It's a fantastic project, and it's really working out for everybody. And it's been fascinating to do it, and we continue to do it. It's grown and grown and grown. It's slowly adding more companies to the watch list, analysing new companies every single day. A lot of that stuff is also going up on the clean watch list, going on the cleantrader.com website. So yeah, I just wanted to share that with you guys. Going forward, I would be keen to do more videos like this, but I'd love to know from you whether or not you find this stuff interesting, whether or not there's any value here for you. If there is, please give the video a like, and subscribe if you haven't subscribed to the channel already, if you find it useful, and I'll do more. Let me know in the comments whether or not you found it useful, and I'll do more. The more companies that I can look at. There's also companies, for example, I can show you a lot of companies that are just dogs. You don't want to touch them. There's a load of stuff going on behind the scenes or in the financials that are just not pretty, and companies that you probably wouldn't want to try and hold on a long-term systematic moving average system, because here's the thing, right? You look at a company like this, and we're putting them in the watch list, and we're looking for long signals. And because the share price is geared to go up, because they're running themselves so well, the share price is likely, not guaranteed in the slightest, but likely to go up. Therefore, if we have a long bias mechanical systematic system, we will benefit from that. We will fine-tune our stock selection criteria. So many traders say to me, look, I understand the mechanics of the trading system. I can trend follow. I can use a moving average crossover system. I can use a breakout system. I can use the Davos box strategy, whatever, right? How do I pick the stocks from 10,000 stocks or whatever you've got access to? How do I pick through them? How do I decide between them? I hear this all the time. And this is how I do it. I look at the fundamentals, I crunch the numbers, what all the numbers mean, how to interpret them effectively, and then I work out basically a criteria that I'm personally looking for, that I've built myself, criteria of what I'm looking for. If a company passes that criteria, which is completely factual, 100% factual, no opinion, anything like that at all, just factual, do the numbers meet the grade? If they do, they appear in my watch list, and I'm finding a direct correlation between the companies in that watch list and the fantastic opportunities that are appearing, like these charts, where had we had a long biased mechanical systematic trading system applied to this stock, we would have made a ton of money. And if you then look at the 10, 20, 30 companies that are in the clean watch list, and that's ever growing, hence why I don't put a specific figure on it, but if you look at those companies and you just traded those companies, long only biased, you would do fantastically well over the last 12 years. Fantastically well. So that's all I wanted to say. I hope you found it useful. Please like the video if you have found it useful. And if it gets enough likes and it gets enough comments from people, I will do more, I promise. If it's not of interest in any way whatsoever, then whatever. You know, if, it won't get the likes and it won't get the comments, and I won't do any more. It's that simple. It's just an experiment, just to see if people find any value in it. Thank you very much for watching, guys, and I will see you again soon. Cheers.